$1.5 trillion vanished in 1 year. That's not a typo. According to the World Investment Report 2025, global foreign direct investments dropped 11% in 2024 to about 1.5 trillion, making a second consecutive year of decline, down from 1.68 trillion the year before. But here is what they are not telling you. It didn't stop there. First half of 2025, down another 3% compared to the same period in 2024. 2 consecutive years, trillions in capital, just retreating. Think about what that means. Every percentage point represents billions in factories not built, jobs not created, technologies not transferred, supply chains not forged. The US, still number 1 destination on the planet, watching money slow to a trickle. The UK, they jumped to 3rd place globally between 2022 and 2025. Not because they are winning some economic beauty contest, because everyone else is bleeding faster. Cross-border mergers and acquisitions, they're subdued. New greenfield investment projects stalling out. And the deal makers are paralyzed. And the reasons? Geopolitical tensions, trade tensions, crackling across every continent. Interest rates are sitting at levels that makes borrowing for expansion feels like a financial suicide. Developed economies, the traditional FDI magnates, are watching their gravitational pull weaken month by month. Subscribe to the Halak Show YouTube channel if you haven't already. If you have, hit the like button, share this with someone who needs to see it, and drop a comment below with your thoughts. Now, watch this number. 75%. That's how much Africa's FDI exploded in 2024. From 55 billion in 2023 to 97 billion in 2024. A record. Not just a good year, a record. While North American and Europeans are watching their FDI charts slope downwards, Africa's line is shooting up like it's been launched from a cannon. Eastern and Southern Africa alone, 65 billion. In 1 year, let that sink in for a second. A region that was once written off as too risky, too unstable, too infrastructure poor, is now pulling in more investments than the entire developed nations. What's changed? The resources are still the same. The infrastructure challenges haven't disappeared overnight. Political stability hasn't suddenly solved itself across the continent. But the money moved anyway. 97 billion doesn't flow into a continent by accident. That's strategic repositioning. That's investors looking at next 30 years instead of looking at the next 3 quarters. That's someone knowing something. Meanwhile, Latin America and the Caribbean down 12%. 164 billion in FDI sounds massive until you realize they pulled in 186 billion the year before. That's 22 billion that went somewhere else. 22 billion that chose different coordinates. Brazil, Mexico, Chile, traditionally powerhouses in the region watching capital choose other addresses. Indonesia tells a different story. 0.1% growth, 53.4 billion compared to 53.35 billion, essentially flatlined. Southeast Asia's manufacturing hub, a country of 275 million people, strategic locations between the Indian Ocean and the Pacific Ocean, and the money just paused. Though their Q4 showed signs of rebound, the question is whether that's a trend or a tremor. The money isn't disappearing from global system, it's relocating. And the relocation patterns tell you everything about who sees the future clearly. Here's where it gets interesting. Not all sectors are dying. Some are feasting while others starve. Digital economy investments, growing AI-related sectors, money pouring in like someone left a faucet running. But here's the catch. It's concentrated. A handful of countries, a handful of companies, a handful of metro areas. San Francisco, London, Singapore, Bangalore, Tel Aviv, which is in Israel. The AI gold rush isn't distributed. It's hyper-concentrated in the ecosystems that already had the talent, the infrastructure, the network effects. If you are not in that club, you're not getting AI money. Period. Infrastructure investments, the unglamorous stuff that actually builds economies, falling off a cliff. Roads, ports, energy grids, water systems. The projects that take a decade to pay back but build the foundation for everything else can't get funded. Renewable energy projects, they are lagging. Same investors who talk about ESG and sustainability at Davos are pulling back from solar farms and wind installations that would actually move the needle. But why? Returns too slow, payback period too long, political risk too high when governments change every 4 years and energy policy flips with them. So the money chases AI models that might be obsolete in 18 months instead of power grids that'll serve communities for 50 years. Short-term thinking eating long-term infrastructure alive. SDG-aligned investments, the UN's Sustainable Development Goals that every corporation claims to care about, are declining. The gap between what's needed and what's being invested is widening, not closing. Turns out sustainability is popular in press releases but not capital allocation spreadsheets. Now, let's talk about India Enigma. 81 billion, that's India's gross FDI for fiscal year 2024 and 2025. Massive by any measure. Fourth largest destination globally. But here is the twist nobody's talking about. Net FDI. It collapsed because gross and net tell two completely different stories. Gross FDI is the money coming in. Net FDI is what stays after you subtract the money flowing back out. In India's case, the money came in fast, but profits flew back even faster. Repatriation went into overdrive. Foreign companies took their earnings and sent them back home at a record rates. So India got the activity, the jobs, the technology transfers, but not the capital accumulation. It's like having massive river flow through your country, but you are not building dams to store the water. But then, April to September 2025 tells a different story. Equity inflows surged 18% in the US dollar terms, 35.18 billion in just 6 months. If that pace holds, fiscal year 2025-26 could hit 70 billion in equity FDI alone. Where is that going? Service sectors, computer software and hardware, the digital backbone of India's economy, not manufacturing, not agriculture, not heavy industries, code, cloud, consulting, the sectors where India has undeniable competitive advantage. English-speaking talent, time zone coverage, cost arbitrage, massive engineering graduates pipelines. Source countries, the usual suspects still lead. Singapore, long the preferred routing hub for capital headed to India for tax efficiencies. Mauritius, another traditional channel despite treaty changes. USA, direct investment from American firms expanding operations or setting up capitative centers. These three have historically dominated India's FDI inflows, and that pattern holds. But India's government isn't sitting idle. They are rewriting the rule book in real time. Defense sector, they are planning to raise the FDI cap from 49% to possibly 74% under the automatic route. That means foreign defense manufacturers could own majority stake without government approval. Why does that matter? India's defense budget is 72 billion and growing. That's a massive market, but it's been largely closed for foreign majority ownership. Opening the doors invites Lockheed Martin, Boeing, Airbus, BAE Systems, the big defense contractors to set up serious manufacturing instead of just partnerships. It's not about buying weapons anymore. It's about making them on Indian soil with foreign capital and tech transfers. What about coal mining? 100% FDI allowed now under the automatic route. India, one of the world's largest coal consumers, finally letting foreign companies own and operate coal mines outright. Insurance intermediaries, 100% FDI permitted. Contract manufacturing, automatic approvals up to 100%. These aren't minor tweaks. These are sectors that were either completely closed or heavily restricted for decades, and they are opening simultaneously. The message is clear. India wants capital badly enough to dismantle the old protectionist walls. The question is whether the investors will walk through those doors or if other factors like bureaucracy, infrastructure, gaps, regulatory unpredictability will keep the actual inflow below potential. Step back and look at the whole board and the strategic game. 1.5 trillion in the global FDI. Down 11% in 2024, down another 3% in the first half of 2025. But it's not evenly distributed. It never was. It's just getting more concentrated now. The US still sits at the top. The sheer size of the American market, the depth of capital markets, the innovative ecosystem, the legal protection, it's still the ultimate destination. But the lead is narrowing. The UK at the third place isn't UK's success story as much as it's an AI and clean energy story. Take those two sectors out, and the numbers look very different. Investment is clustering around two things: cutting-edge technology and strategic national interest. AI, semiconductors, quantum computing, biotech technologies that governments believe will determine competitive advantage in the next 50 years. Countries aren't just competing for investment anymore, they are competing for the type of investment that builds technological sovereignty. That's why you see a massive subsidy. The US CHIPS Act, Europe's Green Deal industry plan, India's production-linked incentive schemes. Governments are bidding against each other with the taxpayers' money and to attract the factories that reach centers they believe will matter in the 2050. Meanwhile, traditional FDI, the stuff that employed millions in steady manufacturing jobs, is getting squeezed. High interest rates make borrowing expensive. Geopolitical fragmentation is breaking up the supply chains that took 30 years to build. Companies that used to think globally are now thinking regionally. Nearshoring, friendshoring, de-risking, those aren't just buzzwords. They are capital relocation strategies that redirect billions. A factory that would have gone to China 5 years ago now goes to Vietnam or Mexico. Not because Vietnam or Mexico is better, but because the risk calculus changed. And trade tensions, they are not cooling off. They are classifying into permanent structures. When the US and China are pulling apart technologically and economically, every other country has to choose which ecosystem to align with. That choice determines which FDI you get access to. India's in an interesting position, close enough to the West to benefit from de-risking away from China, large enough to demand respect, but also maintain a relationship across the board. Africa's FDI surge, part of that is China's belt and road orienting towards the continent. Part is Western countries looking for critical minerals for batteries and clean energy. Part is genuine demographic optimism. Africa will have 2.5 billion people by 2050. That's not the market you ignore. Latin America's decline, partly political instability, partly commodity prices fluctuations, partly investors deciding Southeast Asia offers better manufacturing platforms. Here is what the official report won't emphasize. FDI flows are lagging. But the time money crosses borders officially, decisions were made 12-24 months earlier. So 2024's numbers, those reflect decisions made in 2022 and 2023, when the world looked different, when the interest rates were still climbing, when geopolitical tensions were escalating but hadn't locked in yet. 2025's decline, decisions from 2023 to 2024. What we are seeing now is the past future arriving. The real question, what decisions are being made right now that will show up in 2026 and 2027's data? Are multinationals expanding or retrenching? Are diversifying geographies or consolidating around core markets? The investment project pipeline suggestions caution. The M&A deal flow suggests hesitation. But beneath the surface, specific sectors are seeing frenzied activity. The problem is they are not broad-based. They are not lifting all boats. You can have record AI investments while infrastructure investments collapse. Both can be true simultaneously. You can have Africa's FDI hit all-time high when the Latin America's decline. The global total drops, but the distribution shifts volatility. India can have 81 billion gross FDI and still see FDI shrink because the profit outflows. The averages hide everything interesting. Singapore, Mauritius, USA, they are still India's top money sources. The routes haven't changed. Africa's getting 97 billion. Latin America's losing ground. Indonesia's trading water. The global total keeps falling, but the money's still moving. AI, strategic sectors feast, infrastructure, sustainability starve. 1.5 trillion searching for right coordinates in an increasingly fragmented world. The question isn't where the money is going anymore. It's what it's running from. And what if we know that we don't before you spiral into the world is falling apart mode. Pause. Notice something quietly hopeful here. Even in the world where 1.5 trillion pulls back, money is still choosing ideas, talents, and long-term beliefs over noise. Capital may be scared, but it's not cynical. It still bets on futures it can imagine. So here is Halak's happiness hack. Don't chase certainty, chase clarity. Clarity beats opinion. Clarity beats panic. The same way money moves towards places that sees its future clearly. Your mind should too. The money isn't disappearing, it's relocating. It's rethinking. It's running from chaos and quietly sliding with conviction. And if you know how to read where the capital runs from, you usually understand the future before it becomes obvious. If conversations like these make you pause and think, share it with someone who enjoys going deeper. like the video if it challenged the way you see the world, and subscribe to The Halak Show, where we don't chase headlines, we uncover what's hiding beneath them. I'll see you guys in the next episode.